Hey, good morning or good afternoon, depending on what part of the country you're in. Welcome to our December market perspectives call. I can't believe that it's at the end of the year already. This will be our last call for 2022, and the next one will be in January. I can't believe it. But momentarily, we're going to be joined by Jim Warner, who is the co-PM and the head of research here at Lear Investment Management. On behalf of everyone at the company, we'd like to thank you for taking time out of your day to join this call. My name is Keith Duran. For those of you that may not know me, I'm a director of business development here. And I'm pretty sure that everybody on the call is familiar with Lear Investment Management. If you're not, however, I think there are a few things that make us unique. And the main thing about our firm is our philosophy, and that we don't believe in static portfolios. Risk in the portfolio should change as risk in the markets and economy change. All of our research is internal, and as a result, that leads to proprietary insights, and that leads us to invest in themes rather than in asset allocation or asset classes and or style boxes. And then lastly, because we believe in the law of diminishing returns, this is a high conviction strategy where we only have a maximum of 30 securities in the portfolio. So this is not a portfolio of good ideas. This is a portfolio of our best ideas. So before I hand it over to Jim, we encourage questions from everyone. If you'll notice at the bottom of the screen, it might be, if you just tap, you'll be able to pull up the Q&A box. There you'll be able to ask questions throughout the presentation. Just put them in there, and we will address those at the end of the meeting. So without further delay, Jim, it's all yours.
Great. Well, thank you, Keith. Appreciate that. Thank you to all of you for joining us today. We've got a lot to talk about. There's a lot going on in the market, so I'll get right to it by sharing my screen. So the title of this month's strategy update is Interest Rate Stabilization. And if you were on last month's call, you know that that's a really big part of our thesis going forward, and something that we've been expecting, and we may just now be realizing. So just to quickly review where the markets are, we finished November with the S&P down 13.1% for the year. The month of November was a nice, strong month for all the indices globally, as you'll see, continuing on a strong October. But this too may just be a bear market bounce. We're not ready to call the all clear on equities just yet, and we'll give you a whole bunch of reasons as to why in the following slides. The Nasdaq is still the worst performing index, down 26%, as you all know. Tech has really struggled as interest rates have increased, and the Dow has basically been the best performer, just off 2.9% year to date at the end of November. Now, all of these indices have come off in the last few days, as we've addressed, various different changes, in particular the payrolls, and we're going to talk about payrolls here in a minute. What's really interesting is to take a step back, because it's really easy to get greedy when things are good, like in 2021, and then it can be oftentimes boring to buy stodgy old great companies. And if you look at sort of the Dow, which is really more full of the more traditional older companies, versus the Nasdaq, which has some of the cool, more exciting companies, you can see that the tortoise, being the Dow, has really caught up and surpassed the hare. So since the beginning of the pandemic, the Dow is now up 27.1%, while the Nasdaq is trailing that at 23.7%. So the lesson here is that valuations and dividends matter. So I think that's an interesting kind of way to pull back a bit, because a lot about what has caused a lot of the big losses this year has been in being too concentrated on the technology names that did so well last year. And if you didn't make that transition, you had a difficult time. Now, I actually misspelled Kathy Wood's name down in here. It's Cathie, but another way of sharpening the point on that previous slide is to look at the difference between how Warren Buffett, more of a value-based investor, has done versus Cathie Wood, who has the high-flying tech stocks in that ARK innovation portfolio. And you can see that he's up 39.6% since the beginning of the pandemic, and she's down 30.8%. So, I think the takeaway here is just that when you're investing more based on greed, which is kind of the Cathie Wood style, you really have to get the timing right. But very few do. And arguably, she's a professional at this, and she's had a difficult time. Meanwhile, Warren Buffett is obviously got a tradition of buying and holding very high quality companies, and it's really kind of hard to argue that that isn't a winning long-term strategy. So something to keep in mind. Now, as I mentioned, we're not feeling too wonderful. We don't think we're out of the woods yet in the stock market. And the reason is twofold. We've not seen any capitulation on earnings estimates or on valuations. If you look at the chart on the left, what we've honed in on is the 2023 earnings estimates for the S&P 500. And you can see this turquoise line. It's come down a little bit, but it's only down 6%, which I would argue is not sufficient if we're going to go into a full recession. And we'll discuss about what our feelings are on whether we do that or not in a bit. But it would still, where they sit today, reflect a 4% year-over-year growth, which arguably, may again be another indicator that estimates could really go quite a bit lower if the economy goes into a full-fledged recession. On the valuation side, the chart on the right, the market is currently trading around 17 times 2023's earnings, and normally what we'll see is a pullback. You can see the 2 times previously this year, we pulled back to 15. And, we just sort of feel like there's a little bit of priciness right now in the market. So just generally cautious and waiting really for a pullback to add any more equity exposure. As I mentioned, the global markets, they've all been relatively well correlated throughout the year. They all basically had a very good November following a very good October, and really facing down the fears of recession, which is, while there's a possibility the U.S. rolls into a recession, there's a stronger possibility that that's the case in Europe, and yet even those indices have seen a degree of resilience. And by the way, all global major economies are facing at the same time decelerating GDP growth, still very high inflation that their central banks are trying to tackle with higher interest rates. So, what's going on here is actually fairly, probably the most optimistic thing I'll say all day. Is that we are now much more comfortable with where fixed income is broadly as an asset class, and have been rotating a lot more money into fixed income. I have a couple more slides on this, but you can see that the problem with this year is that if you look at the top line, the Bloomberg U.S. Aggregate Bond Fund is down 12.6% for the year. This is the safe money that everybody thinks is somewhat guaranteed when they put money in bond funds, but obviously not in a severely high, a much higher interest rate environment. The speed at which the Fed is act and the speed at which the market is react to address the inflation concerns, has created this surge in interest rates, which is really a horrible environment for the bond market. This is one of the worst losses that we've seen in quite some time. But what it has yielded, kind of pardon the pun, is a generational opportunity to buy very high quality fixed income and get very nice yields on that. And we'll talk more about that. So one of the things that we talk to our clients about is that, by and large, give or take, the typical private client needs about a 7% return every year to meet their retirement goals. And the nice thing about 7% is it's almost basically an equity-like return. But if you use the rule of 70, that means you double the portfolio in size every 10 years. Well, what a difference a year makes. If we look at where we were sitting a year ago, we were basically saying to people, you can't be in bonds, they don't have enough yield, you've got to be in stocks. And, 1 year ago, the 12-month T-bill was at just 0.3% or about 28 basis points. So that meant that to get that 7%, let's call it a required return for the investor, you needed to take 6.7% or get 6.7% of that return from risk, namely stocks and maybe some commodities. Well, that's changed dramatically in the last year. Today, we sit in a place where we haven't been probably since the mid 90s, where you can get a 12-month T-bill for 4.7%, which is virtually a riskless security that you could just hang on to for the next 12 months. You get your money back plus 4.7%. That's about as guaranteed a return as we've seen in quite some time. And of course, if you look across other fixed income classes, you can get even better returns in that with, than 4.7% and take only, a little bit more risk. So that basically means that we don't have to go into equities as strongly as we historically needed to in order to meet this return hurdle. But surely, all clients like to see a better return than 7% when the opportunity presents itself, which is why it's important to keep some foot in the equity market. One of the other reasons that we're not as enamored with the overall stock market versus say the Treasury bill, Treasury notes, is just the relative valuation has really collapsed to a point where, relative to history at least, it's the yield that you get off of treasuries is better vis-a-vis the risk you have to take to get the current 5.4% yield off the S&P. Now, one of the things, as I mentioned, the title of this presentation is Interest Rate Stabilization. And this chart does a good job of suggesting that that is in fact occurring. This is a graph of the Fed funds curve. The gray bars on the left is where it was on October 31st, and the blue bar to the right is where it stood on just the other day on December 5th. And what you can see is not much change, and that's really key. So basically, the market has gone through now in the last month, has digested another CPI report, another payroll report, and various other data points, and has basically not moved very much, which is a good sign, particularly if you're a fixed income investor. There is still the expectation that the Fed will raise 50 basis points at their next meeting, which is on the 14th of this month. And there's an expectation that they will have to cut 50 to 75 basis points next year, towards the back half of next year. Now, this is contrary to the Fed's own projections. And so it'll be really interesting to see if the Fed changes their view when they put out a new set of forecasts on the 14th. But basically what this is telling you is that the market doesn't believe the Fed that they will be able to keep rates where they are. They actually believe that economic softness, maybe comes in the form of a shallow recession or even a mild recession, deeper recession. But the point is that the market is already expecting that inflation's going in the right direction, the economy is going to soften, and therefore the Fed will have to ease off the brakes. And that's just that red line is just essentially the Fed's current projection. So you can sort of see that the market is already expecting beyond, rate hikes beyond what the Fed has already indicated publicly. So what this means is that when you get interest rate stabilization, you should get lower bond volatility. And this has been something that has plagued the fixed income market all year. The MOVE index, which I have depicted here in this slide, is a measure of that bond volatility. What I've left in here is you can see the big spike that happens in the middle of this graph. That's the pandemic. So that's when literally the credit markets seized up and the Fed had to backstop the credit market. We got back to that level of volatility over the last year as the aggressiveness of the Fed in raising rates really roiled the bond market. And so, while you can see that that the bond volatility has come off from its highs, we would expect, if in fact rates have stabilized, that will continue to trend lower. And that's a really positive sign for the bond market. And I'm going to use words like bond market and fixed income interchangeably, just like I use the words equities and stocks interchangeably. So just real briefly, where do we sit today in terms of rates? Well, the 2-year has really stabilized also. around this kind of just above 4%. And as has long-term rates have actually pulled back they surged up to north of 4.25. And as of yesterday or today, it's around 3.5%. Any sort of stabilization around these levels provides a better environment, not only for fixed income like we've discussed, but also for growth stocks. And so you've started to see, for example, the QTech, which is the equal weighted NASDAQ index, and something that we've been adding to portfolios over the course of the last 6 weeks, has rallied really strongly off the bottom of that. And why is that? And then it's because these higher growth stocks, of which are somewhat reflected in the QTech in and of itself, will actually bounce back faster because they've been the hardest hit. Why have they been the hardest hit? Because of higher interest rates. So when interest rates actually start to stabilize or even decline, those stocks and their valuations can rebound. So we see a little bit of that going on. Possibly our number one pick right now, our most favorite asset class, is mortgage-backed securities. This is a incredible opportunity. Mortgage-backed securities are sensitive to really two things. One is the base rate, and then the spread on top of that. And oftentimes that's measured by credit risk. Well, these are Fannie and Freddie Mae mortgages, and they are guaranteed securities. So there shouldn't be much in the way of extra credit risk, and maybe some liquidity risk thrown in there. But what you can see is this massive correction in spreads. So spread is just simply the yield of the security over the base rate, which in this case is the 30-year Treasury. And you can see this huge pop. And I drew this red line to show you that the spreads have blown out even further than they did during the housing crisis, which is really remarkable considering the incredible defaults that were going on in the mortgage space at the time. So, if you scan your eyes to the left a little further, you'll notice that we're basically at the levels that were experienced during the really high inflation periods of the late 70s and early 80s. So, when you get opportunities to buy, base rates that have probably stabilized and spreads that are ultra wide and not have that credit fear, this is really a pretty remarkable opportunity, and one that we've been really trying to take advantage of. I'll touch briefly on commodities, and I think the biggest thing to talk about here is really gold and what's been going on there. It's outperformed, but still been a little bit down on the year, which to some extent is a little surprising, because it tends to be a store of value, and in times of high inflation should outperform and actually gain in value, but it hasn't this year. But a large part of driving that is that it's inversely correlated to the dollar, and the dollar has been remarkably strong, driven by the speed at which and the degree to which the Fed has raised interest rates. It has caused the dollar to really work a lot higher. This is just a graph of the GLD, which is the gold ETF, versus the Dixie, which is the broad measure of the strength of the dollar. And if you invert it, you get obviously very similar looking lines. So if the dollar is actually peaked, which we think it has, this is probably a really good time for gold. And also it's going to help corporate earnings to some extent, particularly the international ones that have exposure to other currencies. All right, so let's just get into a core economic update. I think it would be remiss, given the time of year, to not address holiday spending and where we are. And thus far, it's looking pretty good. There was, coming into the holiday season, retailers were over inventoried. And so and with the expectation of softening consumer demand, of which we actually haven't really seen it, there was an expectation of heavy discounting. And I think if any of you, been shopping, whether it's online or in stores, you've noticed that there's a lot more sales going on these days to attract customers. And certainly those sales did a good job of doing that. You actually had almost 200 million Americans shop over the Thanksgiving weekend. That's almost a 10% increase year over year. So, it's just an indicator that there are people out there wanting to buy Consumers are, they're not tapped out apparently just yet. Cyber Monday set another record. And by any metric, it looks like this retail season is going to come out to be pretty good. Now, the question is, of course, at what cost to the retailers' margins, given all the discounting? And so we've been, fairly negative on this consumer discretionary segment for that reason. But it seems like the top line is hanging in there. Part of what could be going on here is consumers are happier. A few months ago, when we gave this, when I gave this webinar, we talked about how incredibly negative the consumer was. And it turns out, if you look at the University of Michigan Consumer Sentiment Index, that the sentiment really bottomed out when gasoline prices hit their peak. And since then, as gasoline prices have normalized back down to pre-Russian invasion levels of Ukraine, the consumer has gotten a bit happier. Now, clearly not super robust, not like it was back at the end of 2021, but these are still healthy numbers. And the other thing too that we're hearing is that consumers are having to make trade-off decisions in their spending, and their spending patterns are changing somewhat to more durables and less discretionary. But by and large, the consumers are getting out there. Part of what might also be happening is that we're sort of through the spike that occurred in food inflation and in food prices, and we would expect that that probably contributed to sentiment. The other thing that's contributing is that that people are employed, and what's remarkable about what's been happening is that with all the talk about an imminent recession, you're still not seeing it in the labor market. The labor market is still very strong. If you look at the chart on the left, the unemployment claims, and we look at this on a 4-week moving average basis to eliminate some of the noise, but you can see that we're still below the 2019 average, which is a super strong, labor market, if you remember that far back. And if you look to the right, while continuing claims, are kind of nudging up here a little bit, they're still well below where they were in 2019. And I guess some of that might be a function of the fact that if you look at job openings through the JOLT survey, there's still 10.3 million job openings, which is, by any sort of relative standard, extraordinarily high. Now, they could all go away overnight, I suppose, but so far, we're not really seeing any sort of dramatic weakness in the labor market. And in fact, if you turn to kind of payrolls, and we had a payroll report on Friday, which kind of kicked off the most recent selling, the 263 jobs added during the month of November in this graph on the left was higher than the 200,000 that Wall Street expected. And that's hence the reason for the sell-off. But you can see, though, that the economy is adding jobs at a slower and slower pace. And, we would expect that to continue. We would expect to hear more layoff talk. We would expect, particularly in the goods sector, more layoffs. And so, we're watching this very carefully, but things are coming down. And this is actually what the Fed wants. In order to sort of stop raising rates, the Fed wants to see a little softness pick up in the labor market. And obviously, you can see over here to the right that we're still at a 3.7% unemployment rate. Who knows where the Fed wants to see that go, but we would imagine that that's going to nudge up over the coming months. Now, if we double click down into the weakest sectors in the labor report, there were only 3 sectors that showed job losses, and they were in general merchandise stores, like retail stores, department stores, employment services, and I'm going to go a little deeper into that on the next slide, and transportation and warehousing. Now, if you've been listening to any of these calls in the past few months, you know that we've been calling for a goods recession. So we've been looking at the economy a bit different, I think, than general consensus. We've been separating out the goods sector, which did so well during the pandemic, where people were buying Pelotons and patio furniture. That's now coming down. And that's what we're referring to as a recession. There's been a buildup of inventories. There's major discounting on things like washers and dryers and TVs and computers and office chairs and all that stuff that we needed when it was work at home, stay at home. We're seeing that part of the economy descend into a very classical form of a inventory-driven recession. Meanwhile, you have the services sector, which is still churning and burning. And those are the experiential things. These are the things that we are going out and experiencing, whether it's going to the movies, traveling, going to restaurants. Those are still very, very strong. But to focus back on this slide, even in these three weakest sectors, we're still not seeing crazy job losses. In fact, if we look at it, pardon me, specifically, general merchandise stores lost 32,000 jobs last month, employment services lost 25, and transportation and warehousing lost 15. Now, the interesting thing about employment services is that the largest component of it is temporary staffing. This is what we call our canary in the coal mine in looking at where we think the labor market is more broadly going. Why? Because first of all, they tend to be business services oriented, but they're the easiest employee to hire and they're the easiest employee to fire. And so they're the first to go at the signs of weakness. And temps lost 17,000 jobs last month, and this is the third month in a row they've lost jobs. So this is kind of a big warning sign that's appeared on our radar screen. Meanwhile, though, wage growth is still strong. And it's really interesting. I mean, historically, wages grow at about 2 to 3% every year, and now they're growing closer to 5%. This is, obviously unsustainably high. Some of it's driven by minimum wage increases. Some of it's driven by job scarcity. But we think that job scarcity is going to soften up. If you believe that there are going to be more layoffs, if you believe there's going to be overall fewer jobs out there, or a shift from jobs back to services, we think the overall pressure on wage growth is going to be down. This is going to be a lagging indicator, and it's a indicator though that the people who in the market that believe that the Fed has to go higher than where we are, than expectations, they believe that this is very sticky, it's going to persist, and it's going to create a big issue. We're not in that group. We're certainly not in the group that inflation is not on its way down. But it's definitely important to point this out because we can't understand a universe where people are losing their jobs and wages continue to grow at abnormally high rates. So for now, in light of a strong job market and very few signs that it's getting that weak, the consumer is still spending. And so this basically means that there's no real big macro demand destruction happening just yet. Now, it might start, and one of the reasons why it could start sometime next year is that if you look at the personal savings chart on the right, is continue to go lower and lower and lower. Consumers are really dipping into their savings, and they're taking out more and more credit card debt, which is now well surpassed pre-pandemic levels to sustain the amount of spending that they're doing right now. And that seems to us rather unsustainable. The one positive thing that we could see in the future for the consumer is that as inflation comes down, and we can see evidence of that, everywhere we look, whether it's goods being discounted, used car prices rolling over, housing prices are going to start to roll over. Wherever you look, there is disinflation. That will be supportive of consumer spending, but consumers are going to broadly be facing more and more difficulty in keeping up this level of spend. So we're expecting a bit of weakness there over the coming months and quarters. Again, I referred earlier to this notion that we've got like two different things going on in the economy. You've got the goods part of the economy is coming down, while the service part of the economy is recovering and going up. And that's confirmed by these two metrics, ISM metrics, which measure their key financial conditions within the services on the left and manufacturing businesses on the right. And you can see that the services have really stabilized out at a nice level of growth. Anything above these diffusion indexes, anything above 50 is still growth. So we're not at the crazy levels of 2021, which were, fiscally and monetarily induced stimulus, driven by those factors, but in this day, without that stimulus and with the higher rates and high inflation, to see services continue to grow at this level is an encouraging sign. Meanwhile, the goods recession we've been forecasting seems to be playing out in manufacturing. This past month, the ISM for manufacturing came in at 49, which is the first print below 50, which means it's actually contracting. If we step back and we then say, okay, well, what's going on here? Like, we've got a stock market that's not pricing in a recession, yet recession seems to be the consensus. What gives? And, I look at the conference board for their estimates, and it's just wild. We've come down from these incredible levels in 2021 to, two negative prints in a row in the first part of this year, which some have argued was a recession. I'd argue it wasn't. In 3Q, we bounced back strongly, and now the conference board is expecting kind of this, this shallow recession to recur, basically starting this quarter and going through the first half of next year, and then a recovery in the back half. So it's what's interesting is the disconnect between, okay, is this a recession? And if so, we need to see the earnings estimates come down. But this also would indicate a fairly shallow one. So lots of moving pieces here, but the general idea is that we need some form of economic weakness is happening in the first half of next year. And, the promise, I think, in the opportunity set is to sort of protect for the next couple of quarters until we have more understanding of where the economy will bottom out. And then you can become finally more aggressive. We'll finally be in that new market cycle. So let me get to kind of the meat of it all, which is, our market strategy. And it's, firstly informed by our baseline economic forecast, which basically just gone through. I won't reiterate all this, but the idea is that inflation's on its way down. The economy is growing at 2 speeds. The consumer is still strong, but we have to wait and see what happens with the labor market. If it softens too much, that would be, that could lead to the goods recession rolling over and infecting the services part of the economy. And then we would have sort of what we would consider a full recession. And so that's the way we're thinking about the US economy. As far as Europe is concerned, we think they are spiraling into a fairly severe recession. And so, we've been very careful to reduce exposure there. One interesting thing, and if we look sort of, turn this around and think more optimistically, where in the world could we go to find actual growth and recovery is possibly China. And, certainly there's been a lot of news flow, even out today, but in recent weeks, about China possibly moving away from their strict zero COVID policies, and one that will allow the economy to open up a bit more and grow. And certainly that would help China, but it would also help a lot of other Asian countries as well. And so we've been spending a lot of time, looking at other Asian economies and businesses to own. So this all gets to kind of our framework that we've shared with you about, a path to a new market cycle. How do we get to that, the other side of this economic weakness, and get through this bull market and get onto the next bull market? So what does it take? Well, first of all, we need inflation to decline. We've got that. It's obviously still elevated. And so that is a sort of ongoing process, but it is on the right track, we believe. We need interest rates to stabilize. I think we can check that box now. Somewhere in this general area of where interest rates is going to be, will create some stability, reduce that bond volatility. And that's why it becomes at a very interesting time to own fixed income. It also allows you to start nibbling at some of these next generation technology companies that have seen their valuations really torched over the last 12 months. We're being very, very picky about what we do there, but that actually provides sort of a bottom for those stocks. The last thing that we're looking for, and I mentioned it earlier and several times throughout, is earnings estimates to stabilization. we need to see estimates stop going down, and or that big, huge capitulation on valuation, which would sort of imply the same thing. And until we get to that time, and I don't know if that's 3 months from now or 6 months from now, what will happen is we'll all start to be looking out past 2023, say, okay, that was a bad year. What does 2024 look like? What do those earnings look like? What is the core earnings power of this business without all this nonsense of high interest rates or high inflation or some of the other drags that are going on? That's going to be the mindset of the market, and who knows when that exactly occurs. But that's the sort of thing that we'd be looking towards in the next couple of quarters. So this leads us to our current market strategy, which is still to remain defensively positioned. We had a nice little, I think, early Santa Claus rally over the last 2 months. But honestly, we're not buying in to this being the beginning of a new upward trend. The estimates just aren't low enough. There's too many announcements for layoffs and things of that nature that need to occur. Even today, you're starting to see capitulation in the analyst community that have ridden down stocks all year long, and they're now finally downgrading them. So, to us, the stock market feels heavy. And that's fine because we have these really great opportunities in the fixed income market. This is, one of these rare opportunities where you can get equity-like returns by owning fixed income. And if you don't want to take any risk at all, you can still own over 4%. You get 4% yields. So, this is not a terrible environment. This is the one very upbeat thing I think we can point out, is that you don't have to be a hero and, buy stocks right now. You can actually hide out now. Finally, after all this, waiting in time and readjustment of interest rates, I think the bond market is finally at a point where it offers what it has normally offered, which is a safe haven from equities when they're troubled. So, as you can tell, we're not bullish on the stock market, but we're bullish on the fixed income market, particularly the higher quality stuff. We still have some question marks about credit risk, and so we're not all in on high yield per se. But that being said, we need to have equities in the portfolio. So what do we do? And what happens as you get closer and closer to recessions is there are fewer and fewer stocks that are super attractive that have the earnings power to power through the recession. So obviously that means trying to find names that are in these very, Keith alluded to it earlier, names that are in these strong secular trends, like, for example, clean energy and some of the things that are mentioned in the Inflation Reduction Act. These are areas of the market where the trends are just incredibly bullish for not just next year, but probably the next 5 to 10 years. And so those are the types of equities that we continue to be attracted to. So I'll stop on this page and then turn it back to Keith. But from a portfolio strategy, the first thing I can tell you is just be patient. I know it stinks, and I know particularly after a year where you've actually lost money, there's this need to buy the dip and get aggressive, and I'd say hold off. It is time to be patient. You have this great opportunity to get great yields on bonds. We can get equity-like returns. And, until we get through this period of economic uncertainty, which again drives earnings uncertainty, we just got to be very careful about where our equity exposure exists. I've listed here a number of different secular themes where we're invested that we think are interesting, and that we're also starting to peer out, over to Asia to see what kind of opportunities may present themselves there. So I'll stop there. And Keith, if you'd like to, moderate the Q&A session, I'd love to hear any questions that you have. There are no dumb questions, and and they're anonymous too, even better. Right. So yeah, take it away, Keith.
Sure, thanks. Great presentation. Let's see, there were, and one of the slides, I think it was on, I don't know, page 29 or 30, it basically had to do with the recession. You had mentioned that that you would argue that the first 2 quarters of 2022 weren't a recession, but then 2023, those numbers looked very similar, right? What would what would be, or in your opinion, maybe the 2023 wouldn't be a recession either? Can you kind of compare and contrast 2022 to what might be in 2023?
Yeah, so I went through this a couple of months ago on what happened to the Q1 and Q2 numbers. What essentially was driving the negative real numbers is the math on how you deal with chain linked 2012 dollars, which is what economists use to derive the real GDP growth. I think that was a complete head fake because mathematically it was being messed up by the high inflation. If you just looked at nominal GDP, it's continued to march up and to the right. So I just completely dismiss those numbers. Who's to say whether the conference board is right on these numbers in 2023? But to me, this feels a little bit more representative of our view, which is that we really now are seeing some cracks in the labor market. But we still haven't really seen it come down. It sort of it seems like we're trending towards kind of a shallow recession. Certain areas though are getting really hit hard, like anybody in the mortgage banking business, right, or the housing market. That's an area that's really gotten hit quite hard and is in a full-blown deep recession right now. But this kind of feels right. It's like that we're going to go through this dip through the first part of next year, and we may already be in this dip, given what we're hearing. But to me, this is sort of, at least from a visual standpoint, I think the right way to think about it, and it's probably the right way to think about the stock market too. The stock market generally bottoms before the GDP or the economy bottoms, but conceptually, I think once we get through pricing in a low enough set of earnings estimates in the market, you'll then start to see a recovery, and it will lead the economy.
Awesome. So I love this crowd. So we've got so far six questions. The first one is, and I know we don't really look at particular asset classes to buy, right, to fulfill some sort of overall checklist. But somebody would like you to maybe talk a little bit about the S&P 600 and small caps. Do you have any words on that?
Yeah, I mean, okay, so small caps generally underperform when we're going into a recession. Why? Because they have fewer resources, they don't have the moats around their business model, and their stocks don't have the liquidity. So generally, you don't want to be in small caps if you think you're going into a recession. Now, that doesn't mean every small cap is not a buy, right? I mean, this is where you really need to go in and pick specific sectors and specific stocks. But broadly speaking, if you want to have a defensive portfolio like we do, we're going to avoid mostly small caps.
How are we feeling about domestic versus international exposure?
Yeah, so we've really geared our portfolio towards U.S. companies over the course of the year. Obviously, the Russian invasion of Ukraine, that basically got us out of Europe in a hurry. We still have exposure to India. We really like that country, and we like the direction of that economy. We have exposure to Japan through a specific name that we think is really, it's a global conglomerate, but it's really poised to win from a number of different perspectives. So what I'd say is that we're now, we've been sort of out of the largely underweight international. Now we're really starting to think about increasing that, and whether that's in some combination of emerging market and developed market, it'll be something like that. But yeah, we're a lot more interested now that the dollar has peaked, and that's kind of a key driver of us wanting to look outside the market. The other two things I'd mention is obviously I referred to, if China is in fact recovering, we want to take advantage of that. Now, while we don't generally like to invest directly into China for a variety of reasons, there are a lot of other countries in the area and businesses in the area, in the region, that will benefit from that. And then I think, if depending on how deep the recession gets in Europe, there could be some really fantastic buys. But I think we're probably 6 months away, or from really spending a lot of time looking through the rubble, if you will.
Right. So this next person actually, which we appreciate, says, love the overview. Can you talk about some names that we really like right now?
Yeah, I mean, I can't really get into specific names. This is something that we could probably do offline, just for compliance purposes. But suffice to say that there's a lot of names that you wouldn't recognize in our portfolio. And then there's some that you would. But what we are really, really focused on is, particularly in the equities world, is finding idiosyncratic names, and those names that are really highly levered to secular themes. I mentioned before clean energy, and there's a lot of really interesting names in there that they're really misunderstood by the market, that we are spending a lot of time on.
Great. So the next question says, terminal rate getting to 5% by March with 50, 25, 25 rate increases. I think they're asking, is it getting to 5%?
Yeah, I mean, that's what the Fed Fund Futures is already pricing in here. I'll go back to that slide for you. Yeah, so if you look at this slide more closely, you'll notice that basically the market is thinking that we get there by the May meeting, it's kind of what the two things that have happened over the last, I don't know, since August really, is that the market has moved up their expectation of where the Fed stops, and they've moved out how long it's going to take them to get there. 6 months ago they were assuming 4% and the December meeting, and now we're 5% in the May meeting. So this market is real time and it changes every single day, but it's really important to focus that this is what the market is. This is what's baked into the market. Like, before the Fed even gets to 5%, the market is already there. Because people always ask me, like, well, what happens when the Fed raises rates 50 basis points next month? It doesn't matter. It's already priced in. So, but yeah, this is where the market sits today. And basically, part of the reason why I think interest rates may have stabilized is that it didn't really change much over the course of the last month. And so I think that's a good sign.
Cool. And so far, the last question we have is, do you still see a 10 to 15% downside in the markets from here?
It's very possible. Very, very possible. On a broad industry index basis, yes, it could. The S&P could easily go down 10 to 15% from here.
Yeah, it's sort of, to me, it's sort of, that's, everybody's like, we're on the precipice of, this maybe a new market cycle, but there's still so much that's hanging in the balance that we again could see this pretty good size downside risk to the market.
Yeah.
Well, I think that'll do it for today. I can't wait for the next months, just because we get sort of a recap, I think, of 2022 and a forward looking on 2023. So I'll just make this quick. I'd like to thank everybody for joining us and taking time out of your day. We look forward to seeing you again next month. Jim, thanks so much. And to everyone else, have a great day.
Great. Thank you, everyone.